Oh boy, Janet Yellen just spoke. I want to give you a breakdown of what she said, but also a little sneak peek of some of the analysis we did in the course member live stream this morning. Oh my gosh. Coca-Cola, Sherwin-Williams, you name it, just the couple that we analyzed this morning. We do a lot of analysis. They can't get prices up. Now they're actively complaining that they're struggling to hold on to the price increases that they had in 2022. And the only place they can brag about raising prices are in places like Turkey and Argentina, where you have basically currencies that are worthless and hyperinflation. It's crazy. It's just such a pisser. What's a pisser is that we know that the forward inflation is like not there. The forward-looking stuff, we had a lot, okay? The going forward stuff is not there. But it's going to take so long for normal Americans to feel that. Most people are still going to go, what do you mean forward inflation has gone? Things sound expensive to me. That's most people. Unfortunately, the longer, what do you mean, goes on, the longer the Fed's like, well, I'll show you then. You don't believe inflation's going away? I'll show you inflation's going away. How does that feel in your stock portfolio? You like that inflation, huh? Like, that's what it feels like. So then you get Janet Yellen, who strikes like the totally opposite tone, right? This is the opposite tone. So this is interesting. Now, remember, Yellen is a figure of the Biden admin. So she has to go from being the Fed, where they have a dual mandate of maximum employment and stable prices, to now I'm Biden's puppet. So there is something, though, that she said that I think she means outside of the political realm. And that's what I want to talk about in this, because it's what I believe. Now, I'm not looking for confirmation bias, but I want to be transparent about this. I highly believe this. And if you've been watching this channel for a while, you already know I believe this. She said the following, quote, longer-term yield trends are still at play. So what does that mean? Well, what that means is that with an aging demographic and capitalism that has led to massive innovation, okay, all big words, basically, what's been going on for the last 40 years is probably still what we're going to see after we get through the inflation bump. Okay, let me try to clarify that in a different way. And the easiest way to do that is just by drawing a very, very high-tech photo, okay? If inflation, since the Paul Volcker era, has basically done that, then we printed money to the moon and we did this. It should be about half as high. There we go. Now we're seeing this. It is entirely possible that this trend of continued disinflation continues, potentially even deflation, and that we are just right here on the ride of going back to that longer run trend. This is really interesting for a Treasury Secretary to say, because to me, it doesn't actually have anything to do with the Biden administration today. This is like the 10-year out game plan, which is, hey, whoa, look, we got to be careful here, because we are still in an environment where likely interest rates will be lower in the long term than they are or have been pre-COVID. Now, that's crazy to think about, because pre-COVID, we were worried about the effective lower bound, the ELB, the 0%. Oh my gosh, if rates are zero, how do we stimulate the economy if there's a recession? Well, you could print a lot of money, or you could potentially go negative, but that could cause some real big distortions. That's what Europe was fighting. Europe had negative interest rates on their savings account before this crisis. And it's so hard to think that, oh my gosh, you're right. Just 4 years ago, we were dealing with negative interest rates. We just printed money to oblivion. Now, that, in my opinion, reiterates why I say in 10 years, mark your calendar for it. And if I'm wrong, I want you to tell me. I'll still have beer with you whether I'm right or wrong. I'm not going to go big ego or, disappear if I'm wrong. I'm going to do my best. I think we're going to see mortgage rates at 1.88% in 10 years from now. And I think, therefore, one of the best investments you could make today is hard assets. Yeah, stocks to some extent as well, but they're extremely volatile. You should definitely diversify to real estate, in my opinion, not personalized financial advice. So I'm a big believer that right now I'm like, how much real estate can, for example, you get your hands on? Because when that happens in the future and rates go down to, potentially lower than where they were in the past, you're gonna look back in 10 years and be like, oh, hot damn, I'm glad I got my hands on some real estate. Or at least you started laying the foundations now, right? Maybe you take the Noob vs. Pro courses, maybe you invest in HouseHack with the fundraise closing on the 1st, whatever, and you learn or you get involved in investing in real estate. That's my idea. If you don't believe that the longer term trends are in play, that's okay. Again, we can still be friends. There are plenty of people who believe that what just happened with COVID broke the longer run trend. They believe that this right here is broken. The reason they believe this is broken is because of deglobalization. That is the argument. The idea is that, okay, well, we are basically trying to get away from working with all these other countries because supply chains broke during COVID. But now I think we realize, wait a minute, we're better off working together with other countries, like, for example, Tesla in Mexico, right? That's an example of what we call friendshoring. And guess what Janet Yellen talked about today? Friendshoring. In fact, she says, look, we're still overly reliant on China for clean energy. But her visit to China, she believes, went extremely well, and that we could build a partnership with China, and that their GDP is probably below trend while ours is above trend, and we can actually work together on a strong economic future. The problem is she believes China needs to get more involved, and she's not wrong, in helping us on the international front. Like, hello, China, where are you with beating up Putin? And where are you with, helping with Israel and Palestine? Nowhere to be found because, wow, they're worried about their own economy and their own people and problems instead. But then I guess you could say we should too, and it gets messy. That's where you get political and really messy really fast. But anyway, point is, what I've been saying for years, and I believe this, is we don't get deglobalization. We get what I call reglobalization, which is, okay, we had so much demand, we broke supply chains. How can we make sure that doesn't happen again by diversifying our supply chains, but also by making them way more efficient? This is why sales at ASML exploded, because all the chip manufacturers are like, we need more machines just in case there's a rush to make more chips, we can do it. It's kind of like what you're seeing now with TSM, where they're like, we have endless demand for these AI chips. We just can't make them enough for NVIDIA. Crazy things to think about. So this is still building out those supply chains. And that's why those H100s sell for like 7 times the cost to manufacture them, because they're so highly in demand and we just don't have enough of them. But anyway, I thought this was very interesting from Janet Yellen. Not only did she talk about these longer term yield trends still at play, I think that was probably one of the big takeaways for me. I'm like, oh my gosh, I can't believe somebody just said that. Like, this to me is like, that's been what I've been believing. Now, you might be like, well, Kevin, you're nuts, and Janet Yellen for sure is nuts. And that's okay. But at least it's fascinating to see Janet Yellen take that sort of point of view, because nobody has taken that yet. People have been afraid to say that because they think that's going to unanchor inflation expectations and cause inflation expectations to skyrocket, which ultimately end up causing problems. Now, I did listen to Christine Lagarde. Even though I covered some of this morning, I went back and I listened to her speech this morning. She is confident that on the measures going forward, inflation is on the right trajectory. Now, when it comes to, are they going to cut soon? No. But in terms of the trajectory, she's pretty confident. And Jerome Powell seems this way as well, to where they're kind of like, all right, now we're just going to keep it here until basically everybody agrees that we've done enough. The concern is, are they going to overdo it? And this has been the concern for years. And the potential where we're now starting to see some higher defaults in autos and credit cards is that y'all gonna go too far. And then, of course, you have this idea that, well, what about the inverted yield curve? Well, Janet Yellen had something to say about that as well. She's like, look, the reason she doesn't think the inverted yield curve, which I have not heard this argument before, the reason she doesn't believe that the inverted yield curve, the 10-2 yield curve, actually signals a recession is because you're seeing long-term yields and short-term yields rise almost equally in all developed countries. But then people argue, okay, fine, well then we're facing a global recession. That is possible. We could be facing a global recession. Totally possible. So I wanted to fact check that a little bit. I looked at the German bond yields and the curves. We didn't actually invert in Germany back in the 2008 recession. We had no inversion. So maybe not necessarily wrong about that, but look at this. Wait a second. We barely inverted in the 2008 recession in America. Right here. See this little drop right below here? Barely an inversion. Now, look at the inversion we had over here. It's a cluster F, minus 100 basis points. It's basically like Paul Volcker over here. This actually was Paul Volcker. This was leading up. This was sort of the first wave of Paul Volcker. This was the second wave of Paul Volcker. So it's really interesting. It's like, wait a minute, the 2008 recession was really bad, but the inversion was nothing. Now we got a deep inversion. And when did that last happen? In the 80s. But in the early 80s recession wasn't that bad. Real estate didn't even go negative. So it's kind of like, what? But anyway, so that's just what Janet Yellen thinks. Again, we just have to kind of put our hats on and go, okay, well, whatever, Janet Yellen. So anyway, she thinks that our economy is going to prove to have grown by 2.5% for 2023. She thinks Americans are worried about the economy, but they still feel resilient. She wants to see real incomes growing, wants to see more people get into EV production and manufacturing because she thinks there's a lot of money to be made there, and for individuals to see growth in their real incomes. Wants to work with China, doesn't see major potential risk factors from the Israel and Palestinian issues that we're seeing now. This all happened at the same time as John Kirby was at the White House saying that the Russian military is now executing soldiers who refuse to follow orders. That's a totally different topic. But anyway, she believes that the economy will have higher yields for longer. Again, the higher for longer that we've seen, but believes maybe that's okay because the economy is doing better. So all of this, in her opinion, cycling to the soft landing narrative. And I want to kind of zoom in to my thoughts on this and go, okay, all right, Janet Yellen, not a surprise. There's definitely political bias there. Let's try to extract from everything she said what's interesting. Okay, well, one thing that's interesting is when we look at the yield curves in 2008, wasn't that bad. Like, I would have rather had the early 80s recession than the 2008 recession. And we are looking a lot more similar to the early 80s recession via the inversion of the yield curve than 2008. Whew. If somebody needed to tell me some good news, I'll take that. Okay. Second thing, this argument about potentially going back to this long-term trend of declining interest rates, I think it's really critical for us to consider that as we're building out our businesses going forward. Because if you're a business owner, if you're an investor, if you're somebody getting started, if you're trying to get educated, I think you probably want to think to yourself, what can I do today to position myself to be in a great place in a low interest rate environment again, if that is what we're heading back to? What can you do now to set yourself up for that? Licenses, business development, foundation building, I call it. Where do you see us being, right? And then, of course, if we are truly in this, oh no, everything's going to deglobalize, geopolitics are too hot, rates are going to stay way higher for way longer. I mean, don't get me wrong, it's possible rates are going to be higher for the next 2 or 3 years, but I'm talking 10 years out, right? So again, how can you milk the yields now to prep for what will eventually likely be an even lower yield? And personally, to me, that's building businesses and expanding businesses around real asset-based businesses. That's why I'm getting all the licenses I could get my hands on. That's why we're building HouseHack and building out the teams so that we can create businesses that are going to flourish for the next 50, 60, 70 years, right? That's my goal. I mean, I'm 31. So I'm trying to look past these next 2 or 3 years because they probably aren't going to be easy. Although I think once we have peak rates set in, we'll start seeing a little bit more enthusiasm again in the stock market. Anyway, there you have it. Thank you so much for watching. Make sure to check out HouseHack. Fundraise expires November 1st. That's around the corner. You can invest with ACH, credit card, debit card, whatever's convenient for you. Email us at ir@househack.com if you have questions. And now, the disclaimer. Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is neither personalized financial nor real estate advice for you. It's not tax, legal, or otherwise personalized advice tailored to you. This is generalized perspective, and this video shall not be deemed reasonably sufficient information for the purposes of evaluating a security. It is not a research report. I personally operate and manage an actively an actively managed ETF, and so therefore we could benefit from stocks going up, and personally own stocks in that positive, bullish, biased world as well. Anyway, how's that for a messy disclaimer? People keep telling me to film it. I'm like, well, it could change every time. Like, I might have to show you the creeper. How am I supposed to record that?
not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.